Okay, I think we will get started. People keep popping in. Okay. See, Happy New Year, everyone, and thank you all for joining us this morning for the Selling Your Business Mini Forum. As always, we'd like to thank our sponsors, Huntington Bank, Fifth Third Bank, Skylight, Raymond, Eastman and Smith, Shumaker Loop and Kendrick, Hylant, and the William Vaughn Company. Presenting this morning, we have Austin Irving and Zach Madden from Shumaker Loop and Kendrick, and we also have Mathieu Beaudoin from MB Capital. Joe Herman from Hylant was not able to make it this morning. So if you have any questions that would pertain to them, please feel free to message us and we will pass those on. We are going to start with Mathieu from MB Capital. So I'm going to hand it over to him.
Thank you, Emily. Good morning, everyone. Thanks for taking the time this morning. Weird way, I think we're all getting used to this type of business meeting, or at least, with this Zoom, we get to see a few faces. It's a lot less stressful for a presenter to just look at a screen than when you have 60 people in front of you. But we'll try to make it fun. We'll try to make it interactive. If you have any questions, don't hesitate to stop me, and we'll get started. So I will share my screen with you guys. We tested it out and it worked. So hopefully we have the same luck the second time. Anybody can confirm that you see my screen.
Yep, we see it.
Perfect. So subject today is selling your business webinar. Is a subject that's on a lot of people's mind as you approach retirement, or even if in a situation in a pandemic, a lot of people think about ways that maybe a life event is going to make you want to make some changes. You're kind of getting tired of the day to day. You realize that it might be time to go do something else. But it's never a bad time to think about selling your business, even though you're not ready or you don't want to sell a business, because we'll go through some slides here, but there's a lot of steps involved to really get your business ready to go on the market and really maximize what you can get from it, and also ensure that your company is going to strive in the future with the new ownership group. Just a quick introduction on myself and MB Capital. So I am an associate director with MB Capital. MB Capital is a small family office. We're a family company. I work with my dad and my two brothers. They are located in Canada. I am the only member of the team here in the US. We do investment in mostly manufacturing companies. Right now, we're invested in 20 different companies: automotive industry, furniture, metal transformation, food distribution, traffic safety industry, and some others. I didn't list the whole list there, but we focus on companies that are between $5 and $50 million in revenue, and we are long-term investors. A typical private equity will have a time horizon on their investment, maybe 5-7 years. But we have companies in our portfolio that we've had for 30 years. So once we find a good companies and we're having fun with the operators, we tend to just stay on board and trying to keep the business to the next level. The reason we are here in the U.S. is I came down here for school. Went to Ohio State. A little bit of a sore subject this morning. I'm sure I have other Buckeye fans on the call. It was a rough night last night, but I think the boys did all they could against that machine from Alabama, which was pretty impressive.
Roll Tide.
Yeah, I have nothing to say because they really deserved it. They were the better team. But so that's why I'm here, and that's why we opened up an office here in Sylvania. I married a girl from Sylvania when I was that we met in college, and so I've been here 5 years. And so most of you guys probably don't really know who we are. because we're fairly new to the region, but we're growing, and hopefully MB becomes a name you can trust here in the region. So the first, the day you decide you want to maybe think about selling, the first thing that I believe you need to do and know is organizing your company for sale. The first step is fairly simple, is really all your corporate organization. Everything that you've got from your company from day one in terms of contracts, stock ownership, options. You might have given stock options to an employee, 10 years ago, he's not there anymore. You want to put everything in order, and you want to make sure you've got all the documentation that's required for the transaction. So, and also one thing to think about right at the first day is the tax implication of your deal. Do you have a C corp? Do you have an S corp? Do you have an LLC? There might be some things to do to kind of move around some stuff before you go on the market to maximize your proceed from the sale, if your advisors can guide you in the right direction. But just to put your corporate stuff in order is step one, in my opinion. Step two, your accounting reporting. Do you report monthly? Do you have your end of the year reporting? Are you just doing a tax return or a compilation of your stuff with your accounting firm, or do you have a reviewed statement or audited statement? I can tell you from the buyer side, companies that have reviewed statement or audited statement are a lot easier to look at, a lot more organized, and it makes a big difference. Once looking at a tax return for an investor is not really what we want to see. We want to see organization. We want to see stuff that's consistent year over year. And, once it's reviewed or audited, then you 100% can trust those statements. So it makes a big difference. So sometimes, you not try to save, but as a personal, you've been, if you've been owning your companies for 30 years, you probably don't need outside advisors to tell you your profit margins and all that good stuff that accountant can do. But once you're in the process of trying to sell, it makes a big difference. Step three, your management team. Who's doing what's making your business successful? So the key things that make your business successful, if it's all on you, the business owner, you might want to think about trying to pass those responsibilities to somebody on your team before you sell your company. Because if let's say I'm coming in and I'm asking you a question about, hey, what makes your business successful, and you say, oh, it's all about how I quote the jobs, and I say, okay, so you're the experts in quoting, who else can quote? Nobody else. Well, then it's kind of a red flag for an investors, because that's what makes the company successful. And if you're planning on being gone to Florida once you sell the business, it's going to be hard for us to find somebody else and trust that they can do the job right away. But if your role as a owner is really just to kind of oversee everybody doing their job, it makes the transition a lot easier. Other things that I put down, your inventory, your working capital. When you own the business outright and you just don't always realize how much money can be sleeping in your inventory and your working capital, because it's just the way you've been operating for so many years. But a typical buyer is going to come in and ask you for maybe a 36-month history of your working capital and your inventory, and they're going to require that you maintain that level at the transaction. So if you've had, let's say, give you an example, you've had $2 million in inventory, but really you could operate with $1 million, you might want to try to kind of take it down to that level where it's optimal, because there's $1 million sitting right there that could be sleeping, that might be required to stay in the transaction if that's how the company's been operating. since day one. A forecast is really important also. Any buyers that come in is going to ask you about your next 3 years. Sometimes if you've been, you haven't been doing forecasting because you know your customers, you know your capacity, you know what you're going to do next year. You just know it in your head because it's kind of been how your business has been functioning for the past 10 years. But the potential buyer is going to want to see some numbers, and they're going to ask questions about, okay, so yourselves, which customers, which product, and it's if you have that and you've done the drill and you're ready to answer those questions, then those forecasts seems to be they seem legit, and then the buyer's going to trust them a lot more than if you just put them together real quick and can't really say where you're going. And then the last step really is you're going to have to go through a due diligence with a buyer, which really he's going to go in your company and he's going to look for every single little thing he can find. So I suggest you do the same before you even sell. I suggest you go in and trying to find every little thing that's been left. You know, is there a lawsuit that was never finished? Is there some old receivable that are sleeping on your book that you just never really, you kind of forgot about it after a couple of years, but you left them there? Like, close out everything that you think somebody's going to ask question about before they even have a chance to ask a question. That's going to save you a lot of time and a lot of energy in the process of selling. The next slide, and I think this is the slide where most business owners are interested in. How much is my company worth? What's the value here? And I'm trying to give you a few options here to how to kind of see what you can get for a company. And my first recommendation is really don't trust the first broker or investment banker that comes to your door and promises you the world. You know, I do a lot of work with those guys, and a lot of them are really great people and do the right thing. But there's a few people out there that are just, you know, that's their job. So they don't get paid if they don't sell a business. So if they call you, they give you a call, or they knock on your door and they come in and promise you, they're going to try to tell you that your company might be worth more than it is. And the reason is maybe if they tell you the truth, you won't be willing to sell. But if they overpromise a little bit, then you'll at least entertain the idea and start the process. So, you know, just you can talk to them, but I would recommend you go and find a second source. And a good source for that is a professional business valuation. There's a lot of people that are certified in that field. They will use market data. They will use strategies. They will use software that everybody's using, and they're gonna give you really a good idea of what your business is worth. And yes, it could be a little pricey, but at least you're gonna start the process with, I think, in the right mindset of what you can get for your company. What are the market conditions at the current, like when you want to sell? I'll tell you right now, if you were in the process of selling in March of 2020, things went south real fast in the M&A market. Things have picked up a little bit more now at the end of 2020 and the beginning of 2021. Here we see more activities, but you know, the market conditions, if you were in the process of selling, it was probably not a bad idea to take it off the market and kind of let this pandemic go through first. And I would think that every savvy buyer out there probably stopped any type of deals they were in because there was so much unknown in the market. The other thing that a lot of people don't realize is, get an appraisal of your equipment and your real estate. The buyers will ask for it. So at least do it. And if it's done, then you've got an idea of what you can get for your real estate and for, the value of your equipment. Sometimes it's been depreciated quite a bit over the years if it's been sitting on your floor for a while. but the market values of a, let's say a stamping press, it's still valuable after 10, 15 years. So get an appraisal. It's going to give you some backing on your valuation if you have more assets than not. And then this is I'm sharing with you here a little graph from Pepperdine University. They do a good research paper every year on transaction sizes, and this is the quickest way to come to a number. And just to give you a ballpark, you can use this chart, and you can see, depending on your industry and your EBITDA, those are the multiples that are most likely going to be applied in a transaction. So let's say you're in manufacturing and you do $2 million in EBITDA, chances are you'll be close to a 6 multiple on a transaction. If you're at 2 million, it might be a little lower than 6. If you're closer to 5, you might be a little bit over 6. But in general, those multiples don't, unless you're in a really high growth industry and you're growing like crazy 100% a year, you might be going with a higher multiple. But a stable business with, let's call it moderate growth, those are the multiples you could be expecting for a transaction. Finding the right buyer. Another really important aspect of the transaction. This is most of the people on this call are family members, they're family-owned businesses. Most of you guys have more than one family member involved in the business. It's not always the best idea to sell to a family members, but it could be a great one too. So depending on your family history or the relationship, I've heard stories on both sides, successful stories and nightmares. So a family members, obviously, for a group like you guys, is an option. Employees is another great option. There's ESOPs now, the employee stock ownership plan, that are gaining in popularity. If you've had people working for you for 10, 15 years, and you trust them, you can put in place a plan where they can pay you over time, and you can put a structure in place that's going to be nice for your employees to maintain ownerships of the business and pretty much keep it going in the same direction you had it. Then you've got your typical investors, the private equity firms, the family offices, and individual investors. I would tell you probably the biggest difference between, and I mentioned earlier a little bit, between private equity and family office is private equity usually has a time horizon on their investment. I'd call it 5 to 7 years, and then they'll probably try to flip the company, while a family office usually is more of a long-term investors, because usually they're investing family money, so they don't really have to repay their investors, their backers in a few years. And then there's the strategic buyers, where a lot of people believe that selling to a strategic buyer, let's say your competition or something like that, you're going to maximize the amount of money you're going to get, because those guys are going to value your products, your business even more, because they're going to create some synergy with what they already have. And quickly here, the step involved in a transaction. Step one, most important step, build your team of advisor. Go to your lawyer, go to your accountant, find an investment banker you can trust. Talk to your insurance people. Talk to get every advisor that are going to be involved in the deal involved really early in the process. It's going to save you time and money. I know we think sometimes we can think about those as expenses, but if you bring in, and I think Zach and Austin will be able to talk to you about this, but the earlier you bring those guys in, the more you're going to get a value for what you're going to pay them. Because if you bring somebody on board, let's say, and you already have a buyer and you're at the last minute negotiating, and then they have to kind of review the whole process no matter what, because they won't give you their opinion on something they're not comfortable with. So if they've been involved since day one, they'll be ready to go. Then get the company ready for the market. Like I mentioned on the first slide, those steps are really important. Get ready to share some information that's going to be shared with potential buyers. And then it's really going to the market. So going to the market, what I described here is just a typical process with an investment bank. So the investment bank will get some information from you. Then they will create a one page, which is called a teaser, and then they'll send it out to their network. And then from there, they'll get some parties interested. The parties that are interested will then sign an NDA. And then once those parties have signed an NDA, then you're going to circulate we call it a SIM, which is a confidential information memorandum, which is a really detailed, probably call it like a 30-page, really detailed book on your companies from employees, from industry, your results, and kind of like your strengths and weaknesses. And you're going to circulate that information to the people that are interested. And then from that document, they'll be able to give you an indication of interest, which will be vague, but they'll be like, okay, we think your company is worth between $6 and $8 million, and we're interested in going into the next step. So let's say you receive 10 IOI, you select the top 4 that you like, and then those 4 go to the next step, which would be a management presentation and a site visit. So then those 4 groups would come in, visit your plant. You would go in more details about your companies with them. You would probably have them meet some of your key people in the organization, and then be ready, because they'll show up with a list of questions that they want to see, that they want you to answer. And because that's really where they're going to go and dig in and say, okay, I really want to make an offer in this company, or I don't. And then once you've done that step, you're going to ask for a letter of intent, which is kind of a formal offer to buy the company. And let's say you receive 3 of those, and 3 people send you a LOI. Then you sit down with your group of advisors and you decide on one. And once you decide on one, usually the deal becomes exclusive to that group for, let's say, 90 days for due diligence. So you decided to go with group A. They'll come in and do their due diligence, which is be ready. It's pretty painful. They're going to go through every single thing in your company from A to Z. A really good investor won't let anything uncovered. They're going to try to learn as much as they can on the business to make sure that the money they're spending is what they think they're spending on a good company. And then once the due diligence is over, then you go to the closing, where you pretty much, you get paid and you transition. And this is where there's still things going on after the transition. But this is a good place for me to let Austin and Zach go on more of the paperwork aspect and more of the legal stuff that you have to worry about once you do the transaction. So thank you. And now I will also make those slides available if people want to have them. But for now, I think I will pass the mic to Austin and Zach.
Thanks, Matthew. Zach, do you want to?
Yeah, so I'm gonna share our screen and tell me if that shows up okay. So we're doing. Austin and I we're partners at Shumaker Loop and Kendrick. Shumaker Loop and Kendrick has offices in Toledo, of course, which is kind of our primary office, and then offices in Tampa, Florida, Sarasota, Columbus, Charlotte, Bloomfield Hills, and Charleston and Sarasota. So we have a kind of a decent footprint, but we're both in the corporate department. We work on these kind of transactions all the time, and help companies through the process of selling their business or buying their business. So, we obviously do both. And it's funny because this is very fresh in our mind. There was a lot of activity at the end of last year. There tends to be at the end of the year of people selling their businesses, and we kind of, I think, learned in that process of doing a number of deals. Just kind of I think good things that are fresh in our minds as to what we would tell people that are preparing to sell their business. So we have a lot to say, I guess, on this. There's a few ways in which you can structure a sale, of course, and there's a lot of reasons to do it that we'll talk about. You can sell the assets of the company. That's where you keep ownership of the entity, but sell all the hard assets of the company to a buyer. You could sell the company outright, meaning just sell all your shares or interest that you have in the company. Another form is through mergers. We see that less in kind of traditional transactions, the merger. What's best, the best form of selling just depends. It depends on your particular circumstances. These are some considerations we'll talk about each of these. I found a big factor is tax considerations. Those are the way that you structure transactions. Often people will decide to sell their business and they really don't have a preference as to the form, and that the form that they choose of the sale really ends up being motivated by tax considerations or considerations that increase the ease of the transaction. These are just the kind of few things that we're going to talk about. We tried to put these slides together and make them robust. We're not going to read off these slides. The idea was that we could distribute these out to anybody that wanted them that would have kind of more information. So, and some of these slides may have more than we'll cover here, but I think gives you a good primer on what to expect when you're selling your business. Some of the commercial considerations that really have to do with kind of what do you want to take on, what are you trying to accomplish through the sale of your business. Is your desire to exit the business? Would you want to stay on as in some sort of consulting arrangement with a new buyer? And often that will drive kind of how the deal is structured. Again, what are your motives? And what are you trying to accomplish? Who are you selling to? Like Matthew said, that a lot of those things will kind of drive the structure of the deal. Asset, just a quick kind of distinction between an asset sale and an equity sale. Equity sales are easier. You just buy the shares and then as a result, you take everything that comes with it. But the easiness of it, there's some risk because when you do that, you bring all the liabilities with you. That you take everything on of the company, its assets and its liabilities when there's an equity purchase. And an asset sale, it allows you to be a little more strategic. So a buyer will come in and kind of pick over your assets and choose what liabilities they want to take on as you kind of negotiate that deal. So even though from a documentation standpoint, an equity transaction is a little easier, the asset acquisition can allow somebody to sell selected assets and assume certain liabilities. So again, it's about what are you trying to accomplish in the transaction, and how do you want to end up afterwards. Tax issues are really important, and we dabble in tax. Austin and I do, but fortunately we have specialists at our law firm that really help us to kind of think through these issues. And you really should rely on your accountants and your tax counsel to kind of say, what are we trying to do? What's the best way to structure that for me? And it can mean a lot of money. It can be a difference in a lot of money about how you structure a transaction. And having a really good accountant or a really good attorney who are looking at that is essential. I think everybody would want to do that, and it's something that we include on every deal. We know, Austin and I know enough to get in trouble, I guess, but we definitely talk with our specialists in our firm about every transaction just to make sure that it makes sense and there's not any unintended consequences to the seller as a result of the transaction. So that is an important issue. Again, I won't read through this. This is kind of this. You guys can read this when leisurely. When you're looking for something interesting to read at night. You can kick up by the fire and read these tax issues section. But needless to say, there's some really good information about selling your business and some of the ways that you can structure it that would relieve you of some of the tax burden. Preparing for sale, I thought Matthew did a really good job talking about that. He was really right on with the process. I found it to be really good to include from the beginning your accountants, your attorneys as you prepare for sale. There's really little for an attorney to do, so it's not like it's a huge expense, but they can kind of point you in the right direction, saying, hey, if you're going to sell your business, these are the things that you need to be aware of. Tell us a little bit about your business. Here's what a buyer will ask. Here's what they'll be looking for. Do you guys have those things together? I thought it was a really good suggestion to kind of run through your own internal due diligence. When I sold my house, for crying out loud, we had somebody come over and really tell us what would buyers look for. And there was some things that we were able to address before we took it to market that I think that made it more marketable. And so I think the same is true with your business. What are some things that you're doing? How is your corporate governance? Are you organized? Are your contracts in good shape? Are there anything in your contracts that would be a problem? And if there are, is there things that you can do to kind of fix those things? But the preparing for sale, it can be, depending on how organized you are in your business, it can be a little bit of work. And I think it makes it easier after you've done that for a buyer to come in and take a look and feel good about the transaction. There's been a number of transactions where we go in and we're looking at a seller's business, and it's a slog to kind of get through their stuff, and I think it affects the deal, and in some way, in some cases, scares buyers away. And so that's kind of what you can do to prepare, and like I said, doing your corporate due diligence and your accounting due diligence, and engaging your lawyers and your accountants early on, even if there's just very little for them to do except provide guidance, I think is good and helpful. You definitely want your attorneys involved at this stage when you really have engaged a buyer and you start talking about terms. There's often things that really kind of the early agreements in the transaction are a term sheet, which is the letter of intent, which just kind of really has a brief description of some of the key points of the deal that you're agreeing to. Sometimes the term sheet has a confidentiality obligation in it. Sometimes that's a separate agreement. That's important because you're going to give a lot of information about the company to the potential buyer, and you want that information protected. Often we do, exclusivity agreements. Again, it's a huge outlay of effort for a buyer to sell their business, and so or for a seller to sell their business. And if we have a buyer and we've engaged with him and we're providing things, we're expending a lot of time and money, and so we usually lock it up, where we kind of agree, the parties agree that we'll negotiate with each other in good faith for a certain period of time. And so that the term sheet, I will say, in my experience, has been something that often we recently had a transaction in which a term sheet was negotiated without the attorneys, and the seller who we represented got a lot of the commercial terms that they wanted, meaning they were really looking at like, what is the purchase price? They really cared about the purchase price, and they ignored some of kind of the other terms that we would consider material. Again, how that purchase price is paid, what is the working capital adjustment, what kind of indemnification do we offer, what kind of reps are required, and they didn't pay much attention to that. And so when we were engaged, they provided us with this term sheet that wasn't very helpful in our negotiations. And so they would have been better off, and I think saved themselves some time and money to really kind of engage their lawyers early on to negotiate that term sheet with them. Lawyers too, we're allowed to be the bad guy, and we can kind of make the business people, really have still friendly relationships, and we can be kind of the hard negotiators and shield that kind of relationship. And I think that's a real benefit, and that's especially appreciated early on at the term sheet level, and really kind of working through that. Usually a term sheet or a letter of intent's, 4 to 5 pages. It's not very long, but it's important. It really gives a roadmap for the deal later on. And so it's important that the roadmap is a good one and beneficial to the seller. After that, after a term sheet signed, that's when you proceed to due diligence. And due diligence, like Matthew mentioned, it's intrusive. If you're selling your business, this is a reason that you want to get organized, because they want to see everything. You usually can negotiate, and we do a really good job of saying they give us a list of the things that they want to see, and we'll respond and say, this is what we'll give you, and this is what we think is reasonable. And so there is a lot of negotiation on that due diligence level of what you have to provide, or what you agreed to provide, and what you just give them comfort in other ways on. So it's important that you, like I said, they'll usually give you a request list of due diligence items that'll include financial and legal things, among other things. And it's a lot of work for you and your team to kind of produce those documents. And the more organized you are, the more prepared you are, the easier that process is in due diligence. And due diligence, it really, the reason the buyer asks for it, it really kind of sets the stage for what Austin will talk about later when we start to document the deal. They'll look at it to determine whether their valuation was good. They'll look at it to determine kind of what things that they may need in the final agreements to protect them, or other things that they may need that we'll talk about in a second. Again, this is just some examples of things that they would ask for, that you would have to give them. Information about your real property, your employees, your intellectual property, your customers, and those agreements. Licenses and permits, and all those things they'll want to see, and they'll want to find out if there's any problems pretty early on, so that they can decide whether they're going to continue to proceed with the transaction. One of the things that a lot of people look at is, what kind of approvals you need, and there's all sorts. I mean, to sell your business, you have to have everybody on board. We represented a company one time where it was run by family members, and the family members the majority of them wanted to sell all their shares in their particular in their company, but they didn't clear that with everyone. And so we got pretty far down the road, and then one of the family members decided, told them that they never intended to sell. And nobody wants to buy 80% of a family-owned business, and so that can really put the brakes on a transaction. And if you have shareholders and not all the shareholders are on board, and you want to sell your business, that's something you have to work out early on with the owners. What do we want to sell? Do we want to sell? Is everybody on board with selling? What is the valuation that we're looking for? Is there a threshold that we won't sell under? And all it's important to work out early on, so you don't spend a lot of time and money and get far down the road just to realize that one of your owners isn't willing to sell. And that's that's this. Again, you know, if you're a corporation, you usually need board or shareholder approval. And your LLCs, you know, it'll be its members, or if there's a manager, those will be the approvals that are required. Some there are regulatory approvals. Now we see not a ton of this, or if we do see a little bit of it, it's usually not that hard to kind of get through. If it's a very large transaction, there can be some reporting requirements and some regulatory approvals needed. But it's something to be aware of, and you guys know your business better than anyone. And if you know of things that you say, you know what, if I'm selling, if I have if I'm a regulated business, like a pipeline business or something like that, and I know that I'll need a regulatory approval, I'll want to do a lot of research into that, see the timing. How is that going to affect the timing? Can I get it? How long will it take me? And that's something you don't want to wait on until you get close to the end, because sometimes when you involve third parties, especially regulatory agencies, they are not fast, and that can cost you something. Another is what do you have in your contracts? Often we've signed contracts and we've agreed to things that really make it difficult to sell or to transfer those to other people. A lot of contractual agreements have things in them like anti-assignment, meaning I can't assign a contract like a lease to somebody without the landlord's consent. Or in some cases, they'll have change of control provisions, meaning if the ownership of my company changes, the contract that I have can be canceled. And so again, we've had transactions where there's been material agreements that make the business valuable. The business is valuable because it has agreements with certain parties, and those agreements can be terminated on the sale, and that's a problem. So for a buyer, they don't want to come into a situation where they're not sure that they can take on all the things, or that first of all, that the transaction would be improved, and even if it was approved, that the contract that they have could continue. So that contractual due diligence and review, and those consents are something that the lawyers look really closely at on both sides. And we're always chasing consents, and that's another thing that a lawyer is very helpful on. They know how to chase down consents. They know how to get a deal done, and they can help and take that burden away from you. But they need to know what's out there, and that's another kind of plug to have good organization when it comes to your contracts and your contractual arrangements. This talks about just some of the liabilities, and just kind of being careful about kind of what at least being mindful of this when you're structuring the transaction. Like when you sell the business, what liabilities do you still hold, and what are you responsible for? And this just kind of walks through that. Some of that can matter, right? You will be responsible for the things before the sale, and you want to make sure that you understand that kind of liability that exists after the sale, if any. Well, this is Austin made me do kind of the boring part, and so he gets to do the exciting part of the purchase agreement and documenting the transaction. But you know, I think that all those things that we talked about, that preparation stage, it makes this stage a lot easier. If you've done everything like that, if you've gauged your attorneys and your accountants early, and you've kind of gone through the process we've talked, it can make the negotiation of the purchase agreement really easy. And so, Austin, I'll pass to you. I will stop sharing so you can share.
Okay. Let me see. Okay. Can you see my screen now, folks? Let me see.
Yes.
All right, very good. Let me get down to where we are here. All right, so we've talked about how we get to this point. And I'll just walk through some of the key aspects of negotiating the purchase agreement, some of the key considerations that happen during, and then maybe some post-closing sort of what happens after the deal is done. Obviously, the first step, once you've gotten through some diligence, the buyer is poked around, is negotiating the purchase agreement. It outlines the key terms and sets the stage. One important thing to note about a purchase agreement is there's something called a sign and close, where the day you dot the line, money is transferred, assets or equity is transferred, or a sign, wait for a period of time, then close. Oftentimes you see that if there's a regulatory approval that's needed in between, or a key consent that needs to be obtained, and you want to be able to show that third party that you've got a signed agreement and things are moving forward, or you just want some good faith investment from the buyer to say, hey, we're ready to move forward. We've got some binding obligations in here to move towards closing. Considerations as far as who's buying the business. If it's a buyer group, you're going to see.
It should be about 10 more minutes.
You're going to see an entity choice, and the key here for a seller is if it's a special purpose vehicle, meaning an entity designed just to hold the assets that they're buying from the seller. Oftentimes we want to include a guarantee from a third party. You don't want just a shell of a company buying you that can't actually stand behind itself for payment of purchase price down the road, or perhaps indemnity obligations of the buyer down the road. In an asset purchase, the key really is identifying the assets and liabilities to be transferred. Most buyers these days are going to be purchasing in what's called a cash-free, debt-free transaction. So buyer will be wanting to say, we don't want any debt with the business. In most instances, that will all be paid and taken out of the purchase price at closing. The flip side of that is we also, in a term sheet, in most cases, a buyer will expect that we're going to have a cash-free transaction too. So say you've done a really nice job of keeping cash in the company, you've got cash left over, except for what's called a working capital adjustment, where they may want a short-term amount of cash to run the business after closing. You get to scrape that cash at closing and take it with you. In an equity purchase, liabilities that aren't extinguished or transferred prior to closing will be assumed by the buyer. So those are usually, handled at closing, where there's no debt. If you've got a line of credit, people will expect that to, in most instances, be paid off at or prior to closing. The main thing for a seller is obviously what's being paid in the purchase price. It's done a lot of different ways, whether it's cash, it's stock in a new company, promissory notes, and the timing of that payment. One thing that we hold true for sellers that we obviously don't hold true for buyers is you need to be, in most instances, very comfortable with the closing cash you're receiving, because there's no guarantee that the remaining cash or stock will be something that comes to fruition. You don't always get that opportunity as a seller, but at the outset, if you want to be comfortable with the sale, you need to be comfortable with what you're receiving in cash at closing. We see too many times where it's structured differently, a seller note or a buyer note, future earnouts, things like that. And there's a lot of influencing factors there that don't necessarily guarantee that you'll get paid, including the fact that you may not even be running the business that you're depending on to do well to pay you future cash. So think long and hard about that as we move along. And then asset allocation, how is your business set up in accordance with tax rules? You want a say in determining the purchase price allocation to get the most favorable tax treatment of how that consideration is being paid for the purchase price. we can skip over this largely, but it's the mechanics are, largely determining what needs to be transferred. I mean, if your business has a number of automobiles, that's a different process than if you have an intellectual property heavy business that requires assignments. And then the agreement also will include, how do we determine who takes receivables? Well, one way you could do it is, hey, we take all accounts receivable pre-closing. Well, that's advantageous to you, but sometimes the buyer might not want that because you're sort of, maybe have the right to collect those receivables and you're meddling in a business you no longer are involved in. It's an important negotiating term for sure. And then we talk about how we transfer third-party contracts. Are there material contracts that you want or that the buyer would want? How do we want to ensure that those are properly transferred at closing? Sometimes the buyer may not really want to notify a seller or a third party that they're buying the business. Could be a competitor, could be other things. If they're willing to take the risk, if they feel pretty good about it, they'll actually wait and not get a consent, and that's kind of becomes a negotiating tactic as you move through the purchase agreement to closing. The thing that we spend a whole lot of time negotiating are representations, warranties, and indemnities. The representations and warranties about the business are statements we are making as seller about the status of all things from environmental to real property to the assets themselves, to employees, to litigation, to the lease or the real property that we own. It's an important negotiating topic, and it goes deep into the entire process. There's also some indemnification provisions that are important in that. Obviously, you're going to have indemnification for a breach or something you said was true that turned out not to be, or that indemnity would say, seller, you're responsible for things you held out as true that ended up not being. It becomes a negotiating tool in the sense of, well, how much am I responsible for? If I'm going to be responsible for the up to an entire purchase price, well, I may not sell. It's up to you, buyer, to look through this business and determine if you're comfortable at some level. On that note, there's things called, so what we do is we negotiate what are called baskets. How about, I'm okay being responsible for this, but up to a certain level. It's the first 50,000, for instance. I don't want the buyer saying, nickel and diming seller for minor things. And maybe that basket, depending on the value of the business, is $10,000. But if we said some light fixtures, for instance, where everything was in good working order, and it turns out that's a $1,500 expense for the interior of the building, we don't want necessarily the buyer to keep coming back with small things until it reaches a certain level. And at that point, we discuss whether that's a tipping basket where we'd be responsible for $1 after it reaches that level, that threshold, or are we true deductible? After it reaches, say, $10,000, we're responsible for everything over that amount. So those are important terms to discuss. Something that's becoming more popular now is rep and warranty insurance, where particularly the buyer is basically saying we will insure against breaches of representations and warranties. We're seeing it more in medium-sized transactions now. It used to be reserved for what I would say are more material purchase prices over 25 million into the 100 million. But they're starting to become pricing, and more companies are becoming entering the market and lowering the cost to get rep and warranty insurance at a lower transaction value. Some key provisions. I'll move quickly through here so I don't keep up too much of your time, but pre-closing covenants. This goes back to where there's a sign, wait for a period of time, and then close. An important thing is ensuring that you as seller continue the business the way you were running it, because that's why they were buying it. They don't want to see you, strip out all the cash immediately prior to, or forget to pay off a lot of accounts payable for a period of time because you know you're selling and it's not, not on your watch, or, make material changes to employees or things like that. That's an important thing that a buyer will want to see. And then there's conditions that are precedent, closing conditions at closing. Maybe, obviously, as Zach discussed, shareholder or member approval, removal of liens, if there's a line of credit out there that's crucial, key consents for material customers or material vendors, third parties. Maybe you have a key piece of software that's crucial to your business running. Well, what we see a lot of times we're buying or selling copier businesses. Key consent, if you buy all your printers from Konica that you put in these businesses, but another printer company is purchasing you. You don't want competitors, don't want sort of a commingling or sale of their business. They might not be inclined to sell or to make an approval. So a lot of different types of approvals really come into play. And then the restrictive covenants. How long do you ever intend to enter the business that you're selling ever again? Do you want maybe some particular carve-outs for certain activities? If you're selling a property management business, and they say, hey, we don't want you entering the property management business for 5 years. You may be okay with that, but you also may want to have a carve out for real estate that you own separate from that. Say, hey, I can manage these specific properties, or continue my small business without really competing with you. So it's important to ensure that those carve outs are important and made established prior to closing, so there's no confusion. Back to the reps and warranties situation, the material sort of base of that is disclosure schedules where we qualify the reps and warranties that we're giving. So how a typical provision would say, except as set forth on this schedule, I have no litigation. And as a seller, we'd say, well, yeah, one of my employees slipped and fell and he's on, paid leave, or, this person accused us of this. And you just make those disclosures to really allow the buyer to evaluate and make a determination as to whether it's important. Anything you disclose on those disclosure schedules at closing relieves you of that liability in almost all instances from having a breach of your reps and warranties. So the buyer may see something material that you've disclosed and say, hey, we need to carve out and put something in maybe an escrow to handle this in case it does pop. Maybe there was a tax audit going on or something like that. But at least you've made them aware and over disclosed. In most instances, that works out for the seller's benefit. We touched on this briefly, but this is an important piece for both buyer and seller. Employee agreements and consulting agreements are important for the buyer, oftentimes to ensure an orderly transition. For the seller, it's also nice to perhaps get some future income. One thing we would say to sellers often, though, is after you've owned a business for a long period of time, you think that you're going to be ready to want to keep working for the business, but things change when you're working for the man instead of getting to be the man or woman. So we want to create an agreement that really addresses your needs and also fits within what the buyer is requiring. Important considerations on those agreements are offsetting measures. A lot of times a buyer will want to say, hey, to the extent something goes wrong in the purchase agreement, we can offset your future payments in consulting and employment agreements. Obviously, as a seller, we say that's a big no-no. We also would like to say as a seller, hey, if you don't pay under a term of the purchase agreement, our non-compete goes away. We're not going to say we won't compete and you also get to not pay. And then sort of retention and trigger payments. What happens if you're terminated without cause? They made you a promise to work for 2 years post-closing. That income's important to you, and they terminate you. Well, any type of earnouts or things like that, we'd want to negotiate to ensure those are paid up front in lump sums as opposed to being paid out maybe pursuant to periodic payments as was contemplated if you were working there still. Less common, but certainly happens, is a transition services agreement. Really allows, say there's a crucial piece of business that you can still provide or assist with them as they kind of get trained up to speed on what you do. A business segment, for instance, they haven't purchased from you, that they want to ensure that they know how to operate that business. That's important. And you see that a lot in manufacturing, that is sometimes combined with a technology aspect. And then last but not least, lease agreements for underlying real property. In the LOI stage, we may want to even try and sneak in that there include an important provision where they're obligated to renew that lease agreement. How important is the lease payment if you own the real property to you? And oftentimes it's very important, ensuring you have a material tenant in there for a term or 2 terms or 3 terms. Those things, sometimes they have a purchase option as the buyer, saying they don't want selling to a landlord they don't know. So we negotiate that as well. We'll pass over this quickly. This really just talks about the actual physical documents to transfer, whether it's a deed for a real estate, an assignment for intellectual property, or a stock power for actually here's my stock, and how that's transferred. Post-closing issues, what happens post-closing? There's announcements, there's administrative matters such as insurance, payroll, pensions, those type of things. The buyer is going to monitor those claims that they may have for breaches. That year, we want to make that period of time they have to examine as short as possible in the purchase agreement. But during that period, whatever that period of time may be, the buyer's going to start poking around now that they really are in there, and say, and hopefully everything is as it should be. And obviously they'll monitor your non-compete compliance during that time as well. This is, in closing, just want to highlight some specialist areas that we often rely on our experts for. And you may not see it in a small business, but it may happen in other instances. So antitrust, we've had a couple of these recently. Antitrust is largely reserved to specific industries or large transactions. So healthcare, you're going to see some antitrust issues from a non-compete standpoint, but largely you'll see for transaction size, material transactions will involve that. Employee issues, you're going to need to identify your key employees to the buyer, and the buyer will want to often keep them on. They want to keep them on as employment agreements, letter agreements, or otherwise. They just want to know who those people are and get them on board with what they're going to do in the future. Do you have a union? That's an important piece. What's your withdrawal liability from that union? It's a crucial expert issue. Employee benefits obviously is important. Whether you keep that employee benefits, do you want to, do you have important life insurance needs to be transferred, things like that. And then last but not least, the WARN Act really has to do with, is there going to be a large layoff of 50 or more employees? That's where that would come into play. Real property, it's an important thing to do your due diligence. I think we've all discussed that. The buyer is looking for the best deal possible and wanting to make sure that everything turns out clean with that property. We've had an instance where we purchased a business, and it would have been nice to know that the seller ran a pipe all the way outside of the business into the creek, but he conveniently didn't let us know that. That was something that we were prepared for in the indemnification, but we did not have the information at the outset. Title insurance is something that's important with respect to getting clean title, but that's an expert evaluation. Environmental issues, the same thing. There's a successor liability that goes with that, and the buyer usually does their diligence, and we try and protect you as the seller to relieve you from that liability. And intellectual property, you may not think you have an IP or important business, but some of the things are your website, or your name, or like I said, a key piece of software that is material to making your business run, that you want to ensure the proper transfer of. We're not talking about PowerPoint or Microsoft Word, but the key pieces of what makes your business yours and how it runs. So I think I made decent time there. If you have any questions, please ask away, and appreciate letting us present to you.
Wonderful. We do have a couple questions. First, what about personal guarantees that I sign while I own my business? Do they cancel with the sale?
Zach, weigh in too. I mean, there's sort of a few types of personal guarantees. I mean, they would cancel in most instances. It depends on what that personal guarantee relates to, though. So, for instance, if the personal guarantee is guaranteeing debt related to the business that's being purchased, and you're paying off that debt, and it's being extinguished in its entirety at closing, then it would be you would be relieved of that personal guarantee. It sort of depends on, I don't know, Zach, what do you think there?
Yeah, I mean, most personal guarantees won't let you assign them, right? So generally speaking, you're going to have to talk to the person in which you gave the guarantee to. Austin's right. If it's like with a loan, that's going to have to be handled as part of the transaction. Now, either somebody else is going to, because that's security for somebody, right, on a particular debt, and they're not going to want to give it up without something in return usually. And so what we've kind of done in the past with those things is, if we can convince I just think mostly of like a bank, right? We convince a bank that the buyer that's stepping in is secure and is good for the debt, assuming the debt's assumed and not just paid off as part of the transaction. Which, like I said, like Austin said earlier, in a lot of cases that's what happened. But in some cases, you'll assume debt, and in that case, you'll have to negotiate with the other side, with the bank, to see if you can replace the guarantee with the buyer, or even just cancel the guarantee because they feel comfortable with the buyer. But that's one of the things where you identify early on, because it's a lot of legwork.
All right, thank you. This question is for Matthew. Does an existing ESOP structure, 100% or otherwise, typically affect the selling business valuation in a positive way or a negative way?
That's a really good question. We don't have any ESOPs in our portfolio. I would see it as probably more of a question for Austin and Zach in terms of a typical buyer. I don't think at the end of the day would have a difference in buying an ESOP or not, or if a group like mine would purchase a company, the ESOP would probably go away. But I really don't want to say something that I don't know. So I'm sorry, I'm not an expert on ESOPs. So I wouldn't be able to give you a good recommendation here.
Really, it's a function of the timing of how long the ESOP's been around. People will purchase, you can really get two bites at the apple when you sell to an ESOP. You have the ESOP existing, but it's a function of how much loan value is left on that ESOP. So typically, once an ESOP sells, there's usually debt and borrowing involved with the sale to the ESOP to pay off the owners who sold originally. So as that goes along, as that debt's paid down, then the sale will become, or the target business will become more attractive. So the less borrowed money, then it becomes just like, in my view, where I've seen any other business, and is very attractive.
Right, and we just have two more here. Are there any thoughts on negotiating contracts to keep current family members employed for a specific amount of time after the sale, or is this frowned upon by buyers?
No, I would say, in my experience, most times if a family member's got a role and they're actually working at the company, because there's a lot of structure where people like to pay their kids or their grandkids just a salary, even if they don't work. But if the family member is in there and actually has a role, it could be negotiated. And also, it's like any other employee. If it's a key member, the buyer will want to keep them.
Okay.
Yeah, I think that's true. I mean, like if it's a sweetheart deal, nobody's going to want that, right? But if they're a key employee and they bring something to the table, often buyers will actually negotiate for that, some sort of consulting arrangement that will exist after the fact.
And every once in a while, you will see a little bit of a sweetheart deal to say, okay, you know, how you know, for 6 months, why don't you stay on, or 12 months? They certainly will make concessions with some convincing.
All right. How do you handle disclosure or lack thereof of trade secrets and or patents pending when negotiating the sale to a competitor?
You typically, and please weigh in anybody, you'll typically disclose all of those things going as you go along. There's a little cat and mouse game as you negotiate purchase agreement and things like that for true trade secrets, customer lists, things like that. I've seen as late as the day of closing where the customer list is not released until they're convinced that the cash will be wired. As far as patents pending, things like that, to the extent it relates to the business, you would want to probably disclose those because presumably that's a value that the buyer is purchasing. If it's unrelated to the core business that's being purchased in an asset purchase agreement, well then you would want to probably just say, hey, this is an excluded asset specifically, anything related to these patents pending, and negotiate that. But it's definitely a cat and mouse game on the know-how, but the know-how is oftentimes an important piece of what the buyer is looking at, and often many times disclosed sort of in the process of due diligence, to the extent that's what the buyer is paying for fair value for.
All right, and I think we have one last one that just came up. What about capital gains issues? How to lower, and what about charitable vehicles?
So, I mean, Zach, again, I think this is a big expert scenario. Capital gains is, you know, the treatment. You obviously want long-term capital gain. I mean, holding an asset for over a year is important to that. And we just would look at your particular situation as to whether you can obtain capital gains treatment. You know, in a stock sale is often, or an equity sale is often preferred for that purpose. But there's things that really come into play. Are you an S corp? Are you a partnership? Do you have an outside basis in your stock? You know, meaning what did you purchase it for to get to be the owner of it? There's a lot of factors in there. Certainly, capital gains treatment is the goal, and you know, we want to make that happen. Certainly, vehicles. If you have a donative intent and you want to give, there's a number of vehicles. Maybe that's probably an entire other webinar, but you know, you want to, if you have a donative intent, you know you want to give in the future, doing that purchase price, donating a portion of it effective as of or immediately prior to the closing can be a great way to do that.
Yeah, and Austin's right. I mean, I think that that's why you kind of engage. We always engage our tax attorneys early on, and we sit with the client. We talk with them about kind of what they're hoping to achieve, and the structure of the transaction, and we work out what's best. And usually both sides can get to really. There's usually not a whole lot of fighting on that. I think it's usually beneficial for both sides, but that is something that's really you look at really early on and say, how can we save ourselves some money solely by the structure of the transaction? You know, and I can't tell you how important that is to spend a lot of time on. Tax attorneys, they're worth their money. They may not be fun at parties, but they're worth their money.
All right. I think that wraps up all the questions. Thank you, Matthew, Austin, and Zach. That was great information, and we hope everyone found it valuable.
I just want to say, if anybody comes up with any other questions or comments, or don't want to ask in front of the group or something, you got my information in the slides. Feel free to contact me. I'm a member of the center too, and just here to help if anybody needs guidance or just a quick question. My door is always open.
Great. And we will be sending out copies of the slides to everyone with a link to the video this afternoon. So thank you all. Have a great day.
Thank you.
Thanks, everyone.
Thank you.